Hello, my name is Julia and this is Fix My Finance. In today's video, we are discussing a very common topic, namely inflation. Specifically, we will cover what inflation is, its causes, how it can be measured, and why most central banks target to achieve a moderate level of inflation. So, let's get into it. Inflation is a quantitative measure of the rate at which the average price level of a basket of selected goods and services in an economy increases over time. Therefore, inflation is a rise in the general level of prices where one unit of currency effectively buys less than it did in the prior period. It is expressed as a percentage increase or decrease in prices over time. For example, if inflation rate for apples is around 2% per year, it means that next year you will spend 2% more on apples than you did 12 months earlier for the same total amount of apples. The inflation rate is one of the key measures of financial well-being because it affects what consumers can buy for their money. And if wages don't keep up with inflation, purchasing power and the standard of living will fall. However, a positive rate of inflation is desirable for the economy as it encourages consumers to buy products sooner and it makes it easier for companies to increase their wages, both of which boost economic growth. This is why most central banks, including the Bank of England, target an inflation rate of around 2%. As you can see on the screen, inflation is currently just below this 2% target, the lowest rate since late 2016. At the same time, wages have been rising at a faster rate than inflation since March 2018, meaning that workers have seen an increase in their purchasing power. In the UK, the inflation rate is measured by the ONS, the Office of National Statistics. The ONS produces three main measures of inflation: the Consumer Price Index, the Consumer Price Index including owner-occupiers' housing costs, and the Retail Price Index. Out of these three, the Consumer Price Index is the most commonly quoted figure. Each month, the ONS collects around 180,000 prices of around 700 items. They use this shopping basket to work out the Consumer Price Index. It looks at the prices of a basket of consumer goods and services, including transportation, food, and medical care. It also includes leisure activities consumers often spend their money on, like cinema tickets, bicycles, and even smart speakers. The prices of all goods are weighted, giving more prominence to what consumers spend most of their money on. So, the price of fuel impacts the inflation rate at a larger degree than the price of stamps, for example. The CPIH is the ONS's preferred measure. It builds on the CPI to include various living costs, including council tax. The reason the RPI is used less commonly today is because whilst it includes some housing costs, it does not account for some people switching to cheaper products when prices rise. Therefore, it tends to overestimate inflation and is typically around 1% higher than the CPI. Now that we know how inflation is measured, let's touch on all the various causes of inflation. Fundamentally, inflation is caused by the money in circulation growing at a faster rate than the supply of goods and services. One reason for this is expansionary monetary policy by the Bank of England. If you're interested in how this works, check out our previous video on the topic. Another cause of inflation is if production costs increase for businesses, example because of increased fuel costs or a rise in wages. These cost increases are then passed on to consumers in the form of higher prices, which in turn can lead to further increases in wages. As we mentioned earlier, the Bank of England has an inflation target of around 2% per year. This is one of the key factors it considers when setting the base rate. As we discussed in previous videos, the base rate in turn influences what commercial banks charge borrowers and the interest rate they pay on savings accounts. So if the Bank of England thinks inflation is likely to be below 2%, it may cut the base rate to lower borrowing costs and therefore encourage spending. In turn, if the Bank of England thinks that inflation is likely to be higher than 2%, it will increase the base rate to incentivize saving. However, as a saver, you should always compare your savings rate with the current rate of inflation. With inflation at around 1.7% per year, any savings rates below 1.7% per year are causing the value of your savings to be eroded over time. This is why you should only keep your emergency fund in an easy access savings account and invest the rest of your money into a higher interest-bearing assets. You should also check that your wage increases at least in line with inflation every year. If it doesn't, you're essentially getting a real wage cut, which means your real purchasing power will fall over time. Therefore, you should renegotiate your wage with your employer if this is the case. Lastly, I want to touch on hyperinflation. This happens when the prices of goods and services are out of control and rise very quickly. It can happen if a government prints money to pay for its spending, which in turn increases the money supply in the economy, causing prices to increase further. It creates a spiral that it is extremely difficult to get out of. A famous example came after World War I, when Germany was left with very high debts. The government printed more of its own currency to pay them off, and the currency lost value and inflation reached 29,500% a month in October 1923. Eventually, the government had to introduce a new currency to get prices under control. Runaway inflation continues to affect countries today, with Venezuela and Zimbabwe being more recent examples. So there we have it. I hope this video has given you an understanding of inflation, what it means, and why central banks target a moderate rate of inflation of 2% per year. If you learned something new today, please give the video a like, share and subscribe for more content. If you have any questions, don't hesitate to leave them in the comment section down below, and I will see you here next time, when it's time to fix some finances.